mode.
Hello everyone, welcome to today's webinar hosted by Admiral Markets, and today Chris is with me. We are going to talk about entries and scale-ins. I hope that you all had a great week behind us, and also we had some holidays today, so actually the market was quite slow. But of course, soon we expect another volatility kick. So this webinar will help you to determine the best entries and how to properly scale in. So we are going to talk about that. But as always, there is disclaimer first. So, risk disclosure statement stating all possible risks associated with Forex market. And by accepting it, you are agreeing also to proceed further with me. Okay, next part. Online education materials are developed by Admiral Markets Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author, me and Chris, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business. This is personal opinion only. This webinar is for informational and educational purposes only. Today's agenda, my part, I will do my part first, then Chris will continue. What is scaling in? Examples, entries, and comparison. Comparison between standard, usual systems which use indicators and systems which is Camarilla MACD, for example, which uses pure price action. So, what is basically a scaling in? Scaling in is a special technique for adding into trades which are either in a relative drawdown or in a profit. So that is a scaling in, adding into trades which are either in a relative drawdown or in a profit. Scaling in is the process of entering a trade in pieces as opposed to putting the entire position on in one entry. Also, a trader that is looking to scale into a trade might break their total position size into quarters, halves, or any other division that they feel might let them take a more calculated approach to putting on a trade. Basically, there is a scale-in. So you probably heard of scale-in. What we usually do is, let's say that the price is going up and we want to buy it lower. Usually we can do this in pieces. One entry, second entry, and third entry. Of course, dividing the total risk. So, scaling in is a very effective technique to use when markets are slow. So usually when markets are slow, there is a big opportunity to enter because you will be following the price by your naked eye. So the worst thing is you enter in a market when there is big volatility. The price can change in a mere seconds. So you can be from profitable trade you could expect usually a losing trade, and that usually happens when market is in a big volatility mood and after some news announcements. So that is why I also do not recommend scaling in or making entries when volatility is huge. We just want to make nice entries, slow entries, with a gradual grinding to our entry, much rather than basically entering at a very fast moving market. That is usually a way to lose that position. There are a couple of ways to scale in. I will explain, of course, the most common and the most precise way to scale in. And of course, need to say that adding into retracement is not the wrong way, because basically if you are making a scaling in, we are adding to retracement. That is not the wrong way, but adding into losers is. So there is a difference in between adding into retracement and adding into loser. There is a big difference. I will explain that, of course. So this is, let's say, an example of scaling in. Let's say that we have decided to trade 0.6 lots, and those 0.6 lots will fit into our 1.5 or 2% of a risk. So basically, you would make a trade with only, let's say, 1 to 2% of a risk if you open 0.6 lots, based, of course, on your stop loss. Stop loss is the primary thing when you decide to enter into retracement. So you need to have a stop loss. If you trade without stop loss, the first thing, you are not a trader, and the second thing is you should leave the trading behind you, and you should maybe play football or something else. That is the most important thing, because if you put stop loss, first it will save your account from further losses, and second, that is the only way how you can determine the risk for a trade. Without a stop loss, you are unable to determine the risk. Else you are trading maybe with 1-to-1 leverage. Else, if you use leverage for trading, that is the only way to determine the risk is by putting a stop loss. Even if you trade with 1-to-1 leverage, it's still, if you trade without stop loss, that means that you use your whole account. The whole account is at the disposal of the trade. So the primary thing is you need to know where is your stop loss. And once you determine the stop loss, then you know how to calculate the risk. So the scaling in is based on a stop loss placement. Trading without it, as I said, don't trade, go and do some other things. Or the second thing is you are not able to scale in properly. That is what I call adding into losers. Adding into retracement is another thing, because if you add into retracement, you know where your stop loss is, and you're basically dividing your overall risk at several positions. But you're adding into losers if you are entering in a trade which doesn't have a stop loss. That is heading into losing trade. Many traders who I know of from ex-Yugoslavia basically burned their accounts by adding into losers. They basically wanted to go long on euro. And you know, a couple of years ago, well, not just couple, some 5 years ago, 6 years ago, when euro was really going down, you know, the big drop in euro versus dollar, those traders wanted to go long, and bye-bye, account has been burned. So that can also happen to you. It doesn't matter. Euro does not have to fall endlessly in order to lose your account. The first premise for wasting the account is trading without a stop loss. So this is the primary thing when we are talking adding into retracement. Without this is adding into losers. So let's say that we can trade 0.6 loss. First entry is at 38.80. Our stop loss is at 38.30. So we have a 50 stop loss, 50 pip stop loss. We can trade 0.6 loss. Instead of entering with 0.6 lots at the first entry, okay, we would divide the lot size according to our risk, and usually placing the trades around retracement levels. I just pick those levels randomly, but you know how to pick retracement levels. You draw Fibonacci lines. You use usually points of confluence. That is how I do. I will show you that later. So first entry is 0.2. Second entry is at 38.60, 0.2. Third entry is 0.1 at 38.50 and 0.1 at 38.40. So that is a total of 0.6 loss. Stop loss is 38.30. TP is at 39.70. What will happen if we basically hit the target price? So if the price goes into your favor and hits TP, you would be making $180 for the first position, $220 for the second position, $120 for the third position, and $130 for the fourth position. It's total of, if you sum it up all, you will get $650 total. So sum it all up, divided entries, scaling in, proper scaling in. So you would have got $650 total. Okay, that is clear. Now, if you had entered 0.6 at 38.80, basically, how much would you got? So you would have made $540, and that's $110 less than by scaling in properly. So if you made your entry here at 38.80, you would have made 90 pips, but that would be a total of $540. Now, if you make scaling ins 0.2, 0.2, 0.1, 0.1 at these levels, you would have made more money actually, but also your risk would be less. So that is why the profit goes exponentially up if you scale it in. Now let's review the same example if the price hit stop loss instead of profits. So as we know, 0.2 first entry at 38.80, adding 0.2 at 38.60, then 0.1 at 38.50, and 38.40, 0.1. Okay, so that is a total of 0.6 lots. Stop loss is at 38.30, target price is at 39.70, and what happened is we hit stop loss. So $100 for the first position, because we have 50 pips stop loss and 0.2 trade. $30 for the second position, $20 for the third position, $10 for the fourth position. So that's a total loss of $160 US. If you had entered 0.6 at 38.80 instead of scaling in, you would have lost $300. That's $140. That's almost double loss. You basically traded 0.6 both time, but with scaling in, you only lost $160, and by entering with a full lot size, full risk at the first entry, you would have lost $300. That's almost double of the loss of scaling in. So that is why the loss goes exponentially down if you scale it in. Now, the only proper way to scale in is to determine your risk, calculate your stop loss, and based on your stop loss and risk, you calculate your maximum lot size. So always, as I said before, based on your stop loss and your risk, you basically calculate your maximum lot size. So let's just say for this showcase purposes, your account is $1,000. You have a risk of 2%, and your stop loss is 30 pips. Okay? So if you're risking 2% maximum, the risk is $20. So your entry should be 0.05 based on your stop loss. If stop loss is hit, then the loss is only $15. That is 1.5%. And I know that many traders trade with full lot on $1,000 account. Is it a proper way of trading? No, it isn't. Why? Because on a $1,000 account with 30 pip stop loss, trading a full empty 4 lot, it's $300 of a loss. That's 30% in a single trade. Is it a proper way to trade? Just tell those mentors who told you to trade with $1,000 with full lot size, go to hell, okay? And you can safely say that I said that. That's stupid. That's nonsense. That is not trading. If you trade $1,000 account with 2% of a risk and 30 pip of a stop loss, your entry is 0.05, not full lot size. Just forget how much you will gain. You don't trade basing on how much you will gain, how much you will be in profit. You are trading based on your risk. Remember that. And remember that now and for always. You don't know how much you will get, but you surely know how much you could lose. And that is the proper way to trade. Stupid way to scale in is if you don't trade with a stop loss and you are adding into losers. That is stupid thing. Now, for properly scaling in, first you need to determine the risk, to calculate your risk. Then, if you want to keep your trading under control, you need to give the price a room to breathe. That is why basically we are going with scaling ins. You should enter exponentially. That means that basically exponentially entering is entering based on either a price action, it's easier way, or based on indicators. I will show you both ways just after this, and you will see what I had in mind. So exponential is adding 0.2, as I said, this is, let me see, 0.2, then 0.2, then 0.1, 0.1, instead of entering full 0.6 in one single entry. So that is exponential trading, and that is called scaling in. You need to have a good method. Proper scaling in requires a good method, and that means you cannot scale in with every system out there. Your mentors or those who have sold you a system need to tell you whether it allows scaling in or not and how to do it, okay? It will usually require some mentoring and practice, because it's not easy also for your mindset. It's not easy to basically develop that mindset to tell you, okay, I won't enter with a full risk, I will enter exponentially. It's a little bit different way of trading. Why? Because if you, let's say that in this example, your first entry was at 38.80, but the price didn't retrace. Sometimes the price will go instantly up if you made a long entry. So you didn't have a chance to add this. Then if you had entered with 0.2 and the price actually hit the target price, you would only gain $100 instead of basically 540. But that is the thing which you need to have in mind. That is the thing which, if you trade with a developed method, with a developed system, it needs to, scaling in can be either incorporated into that trading method or not. So there is no gray, there is only black or white. Either it can use a scaling in or it cannot use scaling in. I also have tested many times. I witnessed that some of those system sellers, marketeers, basically were selling the snake oil. You probably won't find much information, and probably those system sellers don't know how to do with their own systems. I presented myself a couple of times as a potential customers, of course faking it, and all of them failed to answer. Can I use scaling in? They didn't know what to say. Or one seller told me, yeah, you can use scaling in. And when I asked him, okay, can you explain how I can use with this method, he didn't answer. So basically, it's full of nonsense and full of false traders out there. Now, this is the one of the showcases for scaling in or trading exponentially. Let's say that we have encountered a bullish pattern here. Okay, this is big bully candle. Then we waited for retracement after this big bully candle, and retracement came in at this point. So, but we also had placed our stop loss here. But based on this system and based on this method, we also can have a second entry here, because we have a double Fibonacci here, 38.2, 78.6, based on intra-week swing and intraday swing. So basically, this is the first possible point, because we have important support, we are buying here at the support, and we are having basically another strong confluence out there. And it's very close to our stop loss. So if we have seen this info, we would probably enter divided. We would divide our risk. So we would enter exponentially. 0.20 here and 0.20 here if the price reaches this level. Basically, the price has reached the level, and we would have been in a much bigger profit than what would be if we traded basically with full risk at the first entry. So that is the example. But this method is naked. It's practical naked trading. It's one of the things I have traded. I traded some time ago before the inception of Camarilla MACD. And basically, practical naked trading was all about entering exponentially. 0.2 here, then if it retraces at 0.2, but keeping your stop loss intact. Okay. Now, another thing to scaling in into a winning position. Now, my opinion is I don't recommend scaling into a winning position except when you trade high time frames. That is daily and above, daily, weekly, monthly. Okay, this is example. Let's say long euro dollar entry 37, stop loss this, target price this. So if you're 20 pips in a profit and you had, let's say 0.20 or more lots at 37.20, that would mean you would trade 0.20 lots more with stop loss now 60 pips far from the second entry. So, you know, I'm not, I don't recommend scaling in. So if you have only 60, 80 pips of target, and you enter there, your stop loss is here. If you entered here with a second position, look at this, your stop loss is there, unless you're willing to risk this position for this position by placing a stop loss here. That is another thing to do. That is trailing the stop. But I don't recommend scaling in. Only if you trade high time frames, daily, weekly, monthly, but I presume that you don't do that. That is the only thing when I would advise scaling into winners. It's more of a risk if you do it this way. Now, entries. Entries are basically different per trading dimensions and style we trade. You know what trading dimensions are. We already talked about it. We have price action systems, indicator-based systems, harmonic pattern-based systems, Renko, range bars, what else? Point and figure, algorithm-based systems. Those are chaos-based. Those are different dimensions of trading. And basically, we need first to determine the dimension we would like to trade. Price action indicator combination, indicator-based, harmonic patterns, etc. Now, based on the method, we would either scalp, intraday, intra-week, or make intraday or intra-week trade. So scalp is short-term trading, intraday is one-day trading, and intra-week is usually keeping the trade during the week. And now, depending on the style, we would either trend, counter-trend, on range trade. So you need first this is the basis. First you need to determine the dimension. If you want to trade price action, then you should enroll for a price action based course, or I don't know, buy or invent price action trading system. Then you need to determine whether you would go short term, intraday or intra-week. And after that you need to determine the style. trend trading, counter trend trading, range trading. Now remember this. This is the only truth. Trend entries are always made on pullbacks. Buying on pullbacks, selling on rallies. Those are the terms we traders use when trade. So, buying on pullbacks. This is a pullback. So when we are buying, we want to see the lower price. This is the primary method of trend trading, because we don't want to buy high and we don't want to sell low, unless we are making a special way of trading that's called breakout trading. But breakout trading is a different style of trading, and it needs, of course, to be covered especially. Chris is also an expert for counter trend, for breakout trading, and we also have included in our Forex Elite course, of course, one of his methods for it's very, very successful for breakouts. But those are different styles of trading. Buying on pullbacks is one thing, selling on rallies is another thing. What is selling on rallies? If the price is going high, you wouldn't sell it there or there. You would basically sell it just a little bit of there, close to resistance. Now, that means if you're following a trend, and this is a trend. This is a trend. And that is not counter trend. It's a completely different way. Counter trend entries are based on high-low selling or buying. Buying at support, selling at resistance. Let's say that we have a strong trend, but we would not wait for next pullback. We would not wait for a next pullback. We would sell it, we would sell it there. So let's say today GBP, now GBP is around 69, right? Now the trend trade is what I made an analysis of. The trend trade would be buying at 68.50. That is a trend trade. Counter trend trade is selling here at around 69.00. That is a counter trend trade. And then we would take profits around this region. And then maybe we would make another entry, buy entry. Okay? That is basically the difference between counter trend and trend. You know that. If you go with a trend, you wait for a pullback, then buy in this example. If you go with counter trend, you don't wait for anything. You just wait for the price to hit important level, or let's see, make a divergence, how we do on Camarilla MACD, and then basically make a counter trend entry. This is the only truth, guys, and this is the only way you should trade. If you trade trend, remember now and for always, buying on pullbacks, selling on rallies. Counter trend entries are buying at supports, selling at resistance. Now, for these examples, I will be using price action system, indicator-based system. Price action method is my Camarilla MACD. An indicator-based system is EMA crossover system. Time frame is 1 hour. This is how it would look like to make a potential trend entry. We have an important Camarilla level here. This is L3. We have previous wedge, which has been broken. It's a type 2 wedge. It's a bullish one. This is breakout pullback continuation. So we have a history of buyers in this region. We also have 61.8 retracement of the last swing. I don't count this swing. I count this swing. It's more valid for me. If I have counted in this swing, I would have made a long entry possible here. But I just don't want to do that. I want to see if price hits important levels such as this, 69, even more. That's 4-year high on cable. I would wait for a substantial pullback to buy. Even though if I'm wrong, if the price goes long around this region, I wouldn't take it because it's too low. I want to see a substantial pullback after it made this high. Okay, so this is okay. This is 70 pip of a pullback, 68.50 zone. We also have a confluence pivot point here, ATR stop, 50% fib retracement. So this region, 68.59 to 68.49, it's basically point of confluence where we can make trades. So that is how I determine my entries on Camarilla MACD. I determine my entries based on points of confluence. Okay. Now this method, this method cost the cost of this method was $500 back in 2011. And this method, look at this method. Now this is simple method. You have 513 EMAs, and you basically wait for a hit of Bollinger Band and for a cross of EMAs to make an entry. In this entry, what would happen in this system? Usually if the price pulls back to this region, it would need another I can say pull back to other side, and then possible entry would be something around this region. Now that would be 25 to 30 pip high from this price action method, because EMAs are lagging. EMAs are lagging. Okay? And you would make your entry 30 pips, 25 to 30 pips far from this region. And it's more clear. This maybe looks more easier because you trade mechanically. You just wait for 513 to cross, first hit of Bollinger Band, then 513 to cross, and then go up. That is sold for $500. I would never buy into this one. Fortunately enough, I saw a correct version, not correct version. One of the guys who actually bought this method was complaining on a forum saying this is a scam. I cannot say this is a scam. This is not a scam. It's okay, you know, but it's not good for $500. This should cost $97 and it would be okay. So this is simple method and ineffective method. Now this is how we counter trend traders use Camarilla MACD traders use counter trend trading. This is regular bearish divergence. Important high, 4-year high, divergence on 4-year high, above H3 level, close to H4 level. This is a sign of counter trend, and at this point the selling was done. At this point the selling was done. Now at this method, you see there wasn't a selling because you didn't get a signal. In this method, for a counter trend method, you would need to have a cross of this to sell. And if you would sell, it would be there, and then you would get 10 pips and you would be probably stopped out. Now look at the difference between Camarilla MACD and between this system. This is proper way of selling. Divergence, points of confluence here. This is above 69.00, and this is 4-year high. You need always to take into account whether this is a monthly low, monthly high, yearly low, yearly high. You need to use common sense. And divergence is the trigger. So this was the trigger for the entry. And in this method, there wasn't even a mention of a counter trade entry. Yeah, maybe $50 right price. I agree. I would agree with you, Nemo. This is plain stupid. Now the conclusion is, and Chris will continue on, the conclusion is not each method can use scaling ins and trend or counter trend entries. First, if you want to be a professional trader, you need to trade scalps. You need to know how to trade scalps. You need to know how to trade counter trends, how to trade breakouts, and how to trade counter trends. That is the way of a pro trader. These kind of systems or methods, which you will pay for $100 or even more sometimes, as in this example, they will only teach you to use mechanical crosses on one or two single pairs. Proper methods and systems will teach you 4 of different way of trading, and they will give you the chance to make trend, counter trends, scalps and breakouts. That is the proper mentorship, and that is the proper way to trade. So the conclusion is scaling ins and making exponential entries is not possible without a good method, without a system which allows you to do that, and without placing a stop loss. That is what I had in mind for you today. Of course, you can ask me later if something is not clear, and now I will hand over the presentation to Chris. So Chris, you can continue.
Thank you, buddy. Good stuff.
Thank you.
One second, folks. I just tried to open this PowerPoint. And screen, there we are. Hope everything is visible. So we can skip the intro. Tarantula nicely already discussed a lot of elements, in fact, so I hope I can add something that is of extra value to you here. As you know, we got market and pending orders that we can take, and we can buy, of course, the entry. We can always enter in a long and short, logically, or we have the wait trade, which means basically just waiting on our hands and waiting for the right environment. Sometimes, by the way, the wait trade ain't too bad regarding the profitability, because sometimes the environment just isn't matching our trading strategy, and sometimes waiting a bit longer before entering makes a lot of sense. So entering, of course, very important. Prior to entry, we have all the time in the world to think and analyze in most cases, because the market makes a lot of retracements. Tarantula was already explaining how many times that we should actually be looking for pullbacks, right? So why can we look for pullbacks? Because the market makes a lot of retracements. So yes, the candles are definitely giving us that potential. Therefore, we have a lot of times, in most cases, to think. Of course, if we're scalping, that time is maybe a bit more limited. But in usual cases, we could have a decent amount of time to analyze what the market is doing when we want. When we enter, we can't take it back, because then the trade is a trade, and no matter what we do after that, even if we click it out a few seconds later, the trade has been initiated and the trade has been closed. So we want to be careful before entering. We also don't want to have too much fear prior to entering. We want to be a bit balanced there in the sense that we want to execute our plan, and we want to be straightforward with the entries, but not too trigger happy and not too jumping in the trade without any reason, of course, for instance, or being too enthusiastic or too much in chasing the trades, for instance. Other way around, we don't want to be too fearful of trading, because, of course, an entry is needed to make profit eventually, so is the exit. So we need a balance there. With the entry methods, basically we can look for breaks, pullbacks, retracements, continuations, bounces, breaks after bounces. The market is always making consolidations and at one point breaking out and making momentum and impulses. Obviously, each type of environment has its own risks and advantages. A consolidation would see something like this happen, for instance, and if the zone is big enough, you could definitely take trades at the top and bottoms here to the opposite side. Eventually, the markets are going to break out to one way or another, and you might see trending modes for a certain distance. Each type of environment requires a different approach. Each type of environment ideally would be traded in a certain way to optimize our results. Now, it depends on how experienced you are. If you're very experienced, you'll be able to tackle the market, as Tarantula was also explaining, in the sense that with various methods and various techniques and strategies to be able to trade the various environments. If you are more starting out with trading, then it would be probably better to concentrate on a type of trading, one type of trading, and focus on learning that better and eventually inside out. than spreading yourself thin over various methods, tools, and indicators. That just undermines the confidence, becomes confusing, and well, it wouldn't be good for the development of your trading career. Better is a method that you start to practice. Of course, at the beginning, everyone has their choices, so you want to shop around a bit, maybe look at this, look at that, but eventually, after, let's say, a test period where you try out various strategies and indicators and tools and see what matches you, you want to start focusing on a set of things that match you and that you start to learn better and better. Entries, of course, definitely has the same thing in a way and are highly connected to the tools you use. But generally speaking, these methods are there. You have the anticipation method or basically the confirmation method. Some people, some traders like to anticipate a bounce or a break. They have the advantage of getting in early. Like, for instance, the example given by Nenad, the Camarilla giving a very nice, relatively early entry at the anticipated bounce spot. The moving averages are giving a confirmation. Therefore, that entry is later, but there is some confirmation that price has bounced. Both have disadvantages and advantages. Depends what you prefer as a trader and how experienced you are, etc. What matches you as well. So, as I was saying, basically, Forex market makes tons of retracements and pullbacks. Every single candle, more or less, every single swing, every single momentum, every single piece of chart almost has its retracements. Now, there are certain cases, occasional gaps, occasional candles that are unretraced areas. Those particular spots that are not retraced are actually sometimes highly regarded as potential trading areas. Why is that? Because the idea is that when price moves away from a certain area without getting any retracement, if price gets back to that area, there will be a likely bouncing spot. So there are traders that specifically focus, or not maybe specifically, but among other things, focus on trading these fills of the gaps. Now, they might not be literally gaps, but they may be unretraced zones. Why is that? Why is an unretraced zone special? Because it doesn't happen too often. Most of the time, everything gets retraced. So if everything gets retraced to a certain degree, why not wait for that retracement, right? So that is the whole point, indeed, and why not? Now, at certain points, of course, at certain spots, the retracements will finish, and eventually you'll get a bit more acceleration into one direction. But then still, even though, let's say, these are building blocks of candlesticks, and each candlestick gets retraced, and this pushes up, and eventually we get a bit bigger acceleration. Then eventually you get some candles that are not been retraced, and you might get a retracement on the swing high, swing low that retraces up to that moment and then bounces again back up, right? So you can see we had a lot of retracements at the beginning. We had retracements of each candle. Later on we didn't, but then the swing high, swing low got retraced, and eventually all the candles did. Let's take a look at the charts here. Let me make a clean chart here on the hourly. Pound dollar hourly chart. Okay? And we have moving averages on the chart, for instance. Okay, some trend lines, etc. If you look at this hourly chart, how many candles have not been retraced? How many candles see the next candle departure from that area and not look back and not retrace that particular candle? Well, as we go along from the very left, this candle gets retraced. Gets retraced, 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 retraced. Well, this one actually has a spot that doesn't get retraced. But what happens? Price dips into that and retraces that candle too. All of these candles are retraced. How about the downside here? We have one candle here that wasn't retraced. But what happened? Price moved away from it, moved back up to the candle that didn't get retraced, and then down again. You see that? Price did move down, but still went up to retrace that area and then down again. All right? So then we had a candle down. Here we have a candle that didn't get much retracement. But eventually, price did get back to that level, didn't it? Otherwise, everything got retraced. Everything gets retraced. Everything gets retraced. Now, you might say, this is a choppy zone. You're pretty right about that. But still, the point is, everything got retraced. Even this big bullish candle retraced. Now, the only exception today in the pound dollar is this 1 hour candle. And this whole chart, where we're looking at 183 candles, only one isn't retraced. So why not plan on a retracement indeed? Why not plan on a pullback? It almost, if you see the statistics, 1 out of 183 not being retraced, it seems to be silly not to. Let's take a look a bit more backwards here in time, because certainly the pound dollar is a bit choppy. And then if you look at, sorry, a bit more trending mode, you will bump into candles that haven't retraced. This one. That's one of them. Here. Second one. Even this one got retraced eventually, actually. So it wouldn't count, but it took long before it got retraced. This one didn't get retraced. This one didn't get retraced. So you do have a few of them, right? Especially if you're in a trending mode. There are going to be a couple of hours that price accelerates, and not always will you get a retracement of that zone, because price can continue with the trend after some consolidation. Like this. We have a trend, consolidation, continue. All right, so those are kind of like unsquared areas. An unsquared area is valuable because when price gets to that unsquared area, it can provide resistance or support. And we know support and resistance are vital. So let me see. I was here. So basically the breakout can move for a certain run, but eventually that run is going to turn into a consolidation. And what we want to make sure of is that we're not entering a trade right in, or at the end, in fact, of a momentum. We don't want to trade with the momentum right when the consolidation starts. Let's say price has moved up and braked and braked and braked, and we enter right here because some major level was broken here on the left, for instance, and we say, okay, that's a good entry. But this has overextended on a shorter time frame, and then it goes into consolidation. How many times does that not happen to traders? And I think it's quite regularly, or at least it happens occasionally. All right? Because, yes, some levels are important, but if you only look at that time frame, you might get stuck in a consolidation on a lower time frame when the lower time frames have accelerated. So that's why multiple time frame analysis is important. That's why finding confluence with entries is important, to have multiple reasons why to enter, and maybe you'll find out that there are actually a few reasons why it's not good to enter at all, and you might avoid a bad entry. This particular element of chasing the trade at its highest point, yeah, is something that's unfortunate, but it does happen, and it's chasing the trade in a way. And definitely a rule of mine is to avoid chasing this market like this. Right? It's like trying to jump on a train. If you have a, if you picture, for instance, a train and it has a speed of 100 kilometers, try with your suitcase to jump on that train. It's not easy. If the train is going slow, preferably standing still at the train station, it's a lot easier to step on board. Well, the same thing is with the momentum. If the market is going fast, it's the same like the train going 100 kilometers per hour. Try to jump on that. It's difficult. But if you got a train that's moving but then slows down with some consolidation like that and almost stands still at the train station, it's a lot easier to hop on board for the continuation. Do you see that? That mental reference there. So as the consolidation occurs, that's actually the kind of the slowdown that allows traders sometimes to nicely enter a trend or a reversal or a range. Now, range and reversals are usually a bit more better to enter with a more anticipating method. However, trends is possible to enter with more confirmation because we could expect bigger moves with the trend. There's bigger spaces left on the trend. Therefore, catching a bit later entry is thereby still a probability that is in our favor, an entry that is in our favor. But the slowdown basically allows for a better entry than trying to catch a momentum that has already passed its peak. Now, certainly some traders might jump into momentum and succeed, but just like trains at high speeds, that's only for stuntmen, and only stuntmen can successfully do that. The same could be said for the Forex, right? So consolidations allow sometimes for good entries. Now, of course, if the consolidation gets too big, you're actually range trading, so you want to be aware of that as well. Alrighty, what kind of tools can a trader use for designing an entry? Trend lines, moving averages, Fibonacci, candlestick patterns, Camarilla, pivot points, fractals, tops, bottoms, high lows, oscillators. All of these and more probably can be used, for instance. I think that's pretty logical, but I just wanted to make sure that that's clear. Now, personally, what I like to do is make a difference between the trigger and the entry. Triggers are pieces of price, areas, zones, levels that need to be broken, trend lines that need to be broken, moving averages that need to be aligned, that tell me, okay, when price does that or that or that, then I'm interested. But I'm not taking a trade immediately at that point. The difference here is that basically it alerts us of a potential setup, but then we still look for the best possible entry, or at least a decent entry. Let's say we have a daily high that was broken. That could be the trigger, but it doesn't have to be the entry. We could wait for the pullback back to the 50 fib, and that could be the entry. Or not even the 50 fib could be the entry. We could wait for some candlestick pattern at the 50 fib. That's the difference. The break of the daily high tells us, okay, this is a currency I might want to trade when I get a good price. Doesn't mean that when the trade gets triggered that that's the price we want to enter on. The break of the daily high might not at all be the price we want. So I like to make that distinction, and I think that helps with understanding the market personally and seeing where you're interested. Having clear levels where a trader is interested in trading a certain currency helps with monitoring, helps with being patient for the trade to develop and not jumping in too early. Because we know, no, that has to happen before I'm trading it. Maybe trading it. Then I'll look for the entry. Now, obviously, with maybe higher time frames, a trigger is less needed because there's more time. It goes slower. You have more time to put a pending order maybe on that, and etc. But still, even with the larger, higher time frames, a trigger and entry system could be very beneficial, I think. Here are some more examples in the middle. Break of the 1-hour trend line. Could be after that you could be looking for entry at the Camarilla, or a bounce at the fib could be the trigger, but the entry could be with the candlestick pattern. The bounce at the support or resistance could be the trigger, but the close above moving averages could be the entry. The break of the fractal could be the trigger, but the pullback to the Fibonacci could be the entry. You get tons of ways of combining this. There's really the options here, the combinations are quite vast in a way of this trigger entry possibility. Let me take a look. Let's take a look at the charts. And let me take everything off. So we have no tools. No, sorry. So we have no tools. We just got a couple of moving averages. So let's take a look. For instance, on the pound dollar recently, I took a long right in here, for instance. Now, why was that? We had this particular chart pattern here, and we had a contracting wedge where we broke the contracting wedge. Now, I didn't trade this break to the upside because from an intraday perspective, it didn't seem to have much space. There was a lot of resistance here, and I expected downside. I didn't trade it to the downside at that point in time, although, as a reversal trader, as a reversal trade, one could have certainly looked for that potential with all these wicks here, indeed. However, that was my trigger the day after to look for longs in this area, which I did. All right, so you can see the difference there between that. This is an hourly chart, example of an hourly chart. So the trigger was the break of the trend line, but the entry was the bounce of price at the 61.8 and 78.6 fibs, what I was looking for. All right. Now, if you didn't want to trade the fibs, you could have waited for some price action. For instance, here you see a couple of candles stopping at the 61.8. That's the stalling spot. That means the price is stopping. If you don't have every candle making a lower, lower, lower high, and you have 5 candles that don't, then that's a substantial pause. Here too, 1, 2, 3, 4. Then the 5th flies up. Here too, what do we have here? 1, 2, 3, 4, 5 candles lows at the same spot. Candle high is being higher and higher. This is slowly building on an upside. This is positive. Sorry, this is positive or bullish, better word, bullish price action. All right, this is slowly building on a turn. If you can read the communication messages that the market is making, trading doesn't have to be that complicated. And any retracement of these candles could have been an entry. Any of these, at the lows, at the lows, at the lows, at the lows, halfway, 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 and you would have had a perfect entry just using the hourly chart here for this upside spike. So if you're more mechanical and you're using the moving averages, you would wait for a close above the moving averages, like this one. Well, then that could be the trigger, right here, up on that close of the candle. That could be the trigger. Doesn't have to be the entry, though. Let's take a look at the 15. You can say, okay, that's the trigger, but I look at the 15-minute chart, right? And I'm looking still for this pullback here before trading it. You could put a fib on the last, I don't know, this last move up here on the 50-minute chart and say, okay, I take the 50 fib. 61.8 fib. That's another way of doing it. Or waiting for the break of the fractal. Of course, that entry is higher, but even that works, right? Because we're expecting it with the trend setup. If you want to analyze the day trading, intraday trading, or let's say trades that are open and closed in the same day, then you want to keep an eye on the hourly, the 15-minute, and 5-minute. Maybe at the beginning of the day, it couldn't hurt, though, just to grasp the day chart. Where are the high and low of the day? Where's the pivot point of the day? And take a look at the 4-hour chart at the beginning so that you have just a reference. Maybe the 4 hours is not necessarily needed. I mean, that depends on you, how much you like the multi-time frame analysis. But so entries is not a complicated thing. All you do want to make sure, though, is that you have a clear understanding of which direction you want to trade it to. And that can vary in the day. You know, at the beginning of the day, we could expect upside, and eventually the upside trend stalls. We get divergence, and we expect a reversal trade. But we want to be, we want to understand what type of trading we're trading, what direction we want, why we want to trade a direction, what are the elements supporting that, and at what point do we see a trigger being hit and a potential entry popping up. Before we enter, we always want to make sure, though, with filters, is there anything that can be blocking the trade as well? So direction and trend is first. Filters, checking filters, step 2. Then looking at what particular trigger would be needed to enter, and then the entry itself. We talked primarily about the entry itself, but as you can see, there's a lot of pre-work done to that, and or not a lot, but at least some, that you want to consider prior to the entry. We just don't want to enter it at any point in time. I mean, we can, of course, but we want to gain as much edge. We want to gain a decent edge there by having some kind of checklist prior to entry, and trying to get that pullback, trying to get a bit of a better price. Each pip, each 10 pips or 5 pips, depending, of course, what time frame you look at, each half a pip, doesn't matter, is a bonus. Every part that we can save on the entry just helps us get either a profitable trade or a more profitable trade or a smaller loss. It's part of the efficiency, of course, in getting the best R2R we can within our trading. The next part, of course, is the exit. Now we can look at tons of examples here, but let's take a look. And these were two examples from me on pound dollar, or three examples, pound dollar examples that I took on this 1 hour chart. Here, to be precise, here and here. And let's look a bit back. I don't know if this is already 2 weeks ago. I don't know exactly anymore. The pound dollar. Let me think for a second. Well, for instance, this, I'm pretty sure that I took this one, but not 100% sure. But this has a clear trend line, for instance. Moving averages are all aligned. This is a good breakout to the upside. Good momentum here, no divergence, for instance. Well, obviously, that is a good upside trade. When we had 5 waves completed here, you don't have to be a wave expert to see that. Definitely, I was not looking for with the trend trades. Actually, I was, if anything, I remember in here that I was recommending to some traders that this could be definitely a reversal spot because of the divergence in play, and this could be a hook back for downside. The downside didn't go far, by the way, but it did happen. Some of it, some part of it. All right. So best and always most important is to understand what types of tools and indicators you would use for deciding the entry. What triggers are you looking for? In our trading room, we discuss that. We discuss what is the trigger, what is the entry. The trading room is on Tuesdays, Wednesdays, and Thursdays from 7:45 a.m. London time to 9:15 a.m. So if you have any questions on your own trading plan or what I use, by all means join us in those days, and you can ask questions. You can ask questions now as well, of course, as always. But if you think of something later on, you can always join the trading room at that point, and we will try to help you in that webinar. Even with reversal trades, here, let's take a look, for instance. Oh, 1 second. Look at this, for instance, right here. You see this this wick here, double divergence on the hourly wick, right? Even that wick and this wick, what did they get? Retraced before you move down, right? So it's quite stunning. Here the difference is only a few pips, but even a big candle like that, right? If you take the entry upon the break of the low, or you take the entry upon the the retracement of that wick, look at that difference in entry. Sometimes it can really add up a lot. So having more patience, waiting for price in the market to go to you instead of chasing it here at 167.17, but taking it at 167.50 or 57. But it's a 40 pip difference there. I mean, this is maybe not a good example because this was actually prior to a weekend, I think. No. Yeah, it was prior to a weekend, but I just saw this big wick and thought it was a good example. So thank you for being here, as always. Once again, we got webinars, as always. Actually, next week there's a bit of a schedule change. I will not have the live Trading Lab webinars next week. I'll be out of office, but the week after, May 13th, I'll be definitely back. Tarantula will have his Monday, Wednesday, Thursday webinars, though, from 6 to 7 p.m. Central European Time, as always. I'll be out though and back the next week. So maybe a question for you: what is your biggest challenge in finding entries? Maybe we can twist it the other way around. Sorry, I'm losing my voice sometimes here. Although that could be maybe a bit of a big question. Yeah, I need some water. I don't have water next to me. I have to grab it. Well, that's maybe a bit of a complicated question to answer via chat, I can imagine. So no problem. I think we can wrap it up for today. I don't see any questions. Otherwise, I guess you would have already written that, I'm sure. Once again, if you have questions, though, you can always get back to this topic at one of our webinars in the future, and we'll take a look at that. In the meantime, I wish everyone great trading still if you decide to trade during NFP, and great trading next week as well. And I'll see you in about 9 days or 10 days or so. Cheers.
Cheers, guys. Talk to you soon. Cheers.